Hi everyone, and welcome to this week's episode of Kickstarter Real Estate Investing. In this week's episode, I wanted to cover two sources of funds which you could use to buy real estate properties. The first one is where you go and buy in by paying all cash. So in this particular strategy, what you're doing is based on the price of the property, you go and put all cash, make an all cash offer and buy the property. Many times the sellers will give you a better rate in terms of a better discount on the property because they get the cash right away, and then they don't have to wait 2 months for a loan to be processed and wait for that particular transaction to complete, right? There are many chances where your transaction might fall through because you may not get a loan or something else comes up. So they really like the fact that a buyer can come to them and make an all cash offer. And you might even get a good deal when you do an all cash offer. But you have to also keep in mind what is the opportunity cost of putting all that money in one deal. Okay, so what I mean by that is, let's assume you have to buy a $200,000 property. In this case, what you can do is you can go and outright pay $200,000 and buy that one property, or you can decide that what if there are two different properties, and in both of them you would make like $100,000 down payment and then take a loan to fund the rest of that property. In this case, what happens is instead of one property, now you have two properties. You've diversified your funds into two different real estate assets. And now based on the gross income you get and the cash flow which is remaining out of it, you can use that and make both the properties grow for you. Okay, so that is one of the trade-offs you would make, like if you go in and buy a property by all cash. Now, there's nothing wrong with it. There are many who do not like to take more debt, and that's perfectly fine. But for those who are okay taking a little bit of debt and able to go and stretch the money as much as they can, then an all cash strategy may not be something they would go after. What they would be going after, which is the next one I want to talk about, is conventional lending, right? So in this case, you go to a banker or a credit union and basically say, hey, I'm looking to buy this particular investment property. What is the best rate you can give me, right? So they can quote you a certain interest rate, and they can then give you an option of saying, hey, do you want to get a 15-year loan? You want to get a 30-year loan? Do you want an ARM product? So we'll cover ARM products in the next episode, but in this episode, we'll keep it simple. And you say that I want to go and buy using a conventional loan. I want a fixed rate loan. Now, the advantage of a fixed rate loan is that you get a very predictable way of knowing what is the rate of interest you're going to pay for the next 15 or 30 years. So what you're doing is you're basically reducing the amount of risk and volatility you might face on a month-to-month basis when the interest rate fluctuates. So because you're on a fixed rate, the interest rate does not fluctuate. You know for sure that this is your expense for your interest and your principal and other things which you might put as part of that. And that will stay the same for the next 15 to 30 years. Now, obviously your rate of interest will be a little higher in that case, but you get the comfort of knowing that the rate of interest will not change even though the market volatility continues, right? So if you look in today's world, for a property which I had bought like 2 years back, I got a rate of interest of 3.75, right? Now that 3.75 stays the same from last 2 years till the next 28 years. So I'm not worried that today the rate of interest is 7% because I already have a fixed rate mortgage going on for that for 3.75. So I don't have to worry when this rate of interest is 7% because my cost of capital or the cost of raising that money stays the same. And that is something you want to reach, is like you want to be at a point where you have a fixed rate mortgage so that your cost of paying your interest and paying down your principal stays consistent throughout the next few years, right? Till the time you sell it or till the time you pay off your loan. Now, there are two different types of period or fixed rate periods you might get in a loan. One is like going to be like a 15-year, other is a 30-year. Now, if you look at it, a 15-year loan logically would make sense because you're paying less interest and you're paying down your principal also pretty fast. So in 15 days, you can have your rental property free and clear, and all the things you make of it, you keep it. You don't have to pay for interest or anything. A 30-year loan, on the other hand, is slow and steady. Is definitely going to be a lower monthly payment you will make on it, but you will be paying for a longer period of time. You'll be paying a lot more interest because you're paying for 30 years. Now, the main thing to look into that is, one is a 15-year fixed rate loan will have a slightly lower percentage of interest because they also want the pay down of the whole loan to be sooner, so that they can take the funds and give it to and loan it to some other individual, right? So it's also in their benefit, the loan gets paid sooner. Now, for that lower interest rate you might get relative to a 30-year fix, you might still end up paying a bigger monthly payment because this is 15 years. It's an accelerated one. Your principal payout is also bigger, your interest payout is also bigger. And even if the interest rate is small, because you're trying to pay out the whole year in 15 years, the payout will be bigger. So you have to take that in mind when you do a cash flow analysis, that do you want a slightly lower rate or do you want to make sure you have a bigger cash flow? Because if you go for a slightly lower rate on the 15-year fix, but your payments are going to be bigger, your cash flow will be less. And you want more cash flow because that cash flow helps you fund your next investment property. Okay, so keep that in mind when you look at conventional loans, like there's going to be the 15-year and the 30-year. There are pros and cons to both of them. You just have to wait and see what works best for you. Okay, hope you like this episode. Please go ahead and like and subscribe if you did. And in the next episode, I'm going to talk about ARM products and how that you can use that to fund your real estate investment. Okay, I'll talk to you next week. Thank you. Bye.